A couple of years ago, I sold a commercial building in Garden City, Idaho. I bought it for $1.3 million, and then 2 years later, I sold it for $2 million. So that was a $700,000 gross profit, and to be honest with you, I felt pretty good about that. I had the rental properties, I had the stock portfolio, I had a commercial deal that was a success, and I figured that I was doing all the right things. And if you're watching this, I'll bet you have a very similar story. Maybe you own a few rental houses, maybe you've built some real equity in single-family properties over the years. You definitely understand leverage, you understand tenants, but if your experience is anything like mine, you've probably also noticed something. The cash flow from those rentals isn't really what you thought it would be once you factor in management fees, the maintenance, the vacancies, and lest we not forget those pesky 2 a.m. calls that you get from your tenants or that your property manager forwards on to you. Now, you've probably got significant equity locked up in these properties, and the returns on that equity are honestly kind of embarrassing compared to what the capital could be doing somewhere else. You're definitely not a beginner, and you've been investing for years, but you've been investing predominantly in one lane: stocks and single-family real estate. And honestly, that's the lane that most of us were shown. Nobody ever really pulled back the curtain and said, hey, there's an entire world of investments beyond this that the biggest, most sophisticated investors in the world have been using as their primary strategy for decades. That's exactly what I discovered when I found a number that completely changed how I think about investing. For example, Yale University manages a $44 billion endowment, arguably the most sophisticated pool of money on the planet. Their target allocation to domestic stocks? Take a guess. It's just 2%. Yeah, 2. Meanwhile, roughly 65% of their capital is in what the industry calls alternative assets, so private equity, venture capital, hedge funds, real estate. Their 10-year annualized return is just shy of 10% net of fees. And they have spent over $15 billion from the endowment in the last decade while the thing was still growing. So I looked at my own portfolio: stocks, a few rental properties, one commercial building. That was the whole picture. 20 years of building and investing, and I was playing in maybe 30% of what's actually available. That seems not right, don't you think? And I'd bet that you're in a similar position, not because you made bad decisions. Clearly you did not. You've built real wealth, but maybe nobody ever showed you the entire investing map. And that's what this video is for. I'm going to walk you through what alternative assets actually are, show you how the biggest institutional investors in the world allocate their capital, break down each major category with real examples, and give you an honest look at the risks, including a deal where my wife and I actually lost money. Now, before I get into it, this is not investment advice. It is purely for information and entertainment purposes only. Talk to your CPA and your own advisors before making any decisions about your own money. An alternative asset is anything you can invest in that isn't a publicly traded stock, a bond, or cash in a bank account. Apartment buildings, farmland, private loans, private companies, infrastructure, all of it. The word alternative is kind of a misnomer. It's only alternative relative to what regular investors have traditionally had access to. For major institutions, this has been their primary strategy for decades. Yale puts about 2% in domestic stocks and 65% in alternatives. Harvard's $57 billion endowment? Well, it's 41% private equity, 31% hedge funds, and just 14% public stocks. Only 14% in the thing that makes up 70 to 90% of most people's 401k. And it's not just endowments. According to data from Apollo Global Management, 87% of companies with revenue over $100 million are private. I would have never guessed that in a million years. The vast majority of economic activity in this country is happening in markets that most investors have absolutely zero exposure to. And at the same time, the number of publicly listed companies in the US has dropped from over 8,000 in 1996 to about half of that today. The opportunity set in public markets is literally shrinking. The opportunity set in private markets, on the other hand, well, that's enormous and it's growing. Now, I'm not here saying that you should try and copy Yale. They have permanent capital, extreme tolerance for illiquidity, and a team of world-class portfolio managers. You and I, well, we're not Yale, but the gap between their approach and ours is massive, and it exists not because alternatives don't work. It exists because most people will never given the option. My wife Liz and I now have roughly a third of our investable capital in alternative investments, and that number is growing. And once you see how this side works, you won't look at a traditional portfolio the same way. There are about 7 major categories of alternative investments, and I'm going to spend the most time on the 3 that I have personal experience with, because that's where I can give you real numbers in real context instead of just textbook definition. Then I'm going to give you a quick overview of the rest so that you kind of have the full picture. First one is private real estate, and I don't mean buying a rental house. I mean pooling capital with other investors to buy something bigger than any of you could buy on your own. So let's say, for example, 50 investors each put in $50,000. That's $2.5 million. And then an operator takes that money and buys a 100-unit apartment building. They improve it, they raise rents, and then they manage the whole thing on an ongoing basis as the general partner. You, as the limited partner, get a share of the income. When they sell, you get a share of the profit. And you never have to talk to a single tenant along the way. This is how my wife and I got started in alternative investing. We invested $25,000 as a limited partner in a mobile home park with an operator that I knew personally. That first deal exceeded every expectation we had. The operator refinanced ahead of schedule, so that was great, returned roughly 70% of our capital back to us, which was amazing, and we retained our entire equity position. So that $25,000 that was invested is now worth much more than that. And I'm telling you the specific numbers because I think it's important. This isn't theoretical for me. It's real money and real deals producing real results. Next, we have private debt funds. So this is the category that changed how I think about risk and return. So instead of buying the real estate like I did with the mobile home park with a debt fund, you're lending money to the people who buy it. In other words, you're the bank. So a house flipper needs $300,000 to buy and renovate a property that's going to be worth $400,000 when it's done. A debt fund is the one that lends them the money. The flipper pays interest every single month, and that interest would then flow to you as a limited partner in that debt fund. The property, well, that's the collateral. Now, just multiply that by 100 loans, and voila, you've got a debt fund. This is where Liz and I are putting most of our capital these days. The funds we're in target rates of return between 13 and about 19% per year net to investors. One of the funds she just invested in with her retirement money, well, it did over 20% last year. Now, I know those numbers sound high. I had the same reaction the first time I heard about them. But when you understand the math, a 3% origination fee plus 12% annual interest and the ability to turn that capital twice in 1 year, it gets to 15 to 20% pretty quickly. And most importantly, you're first in the capital stack, meaning that you get paid before the equity investors ever see a dollar. Now, I've done a full deep dive on debt funds in a separate video. And if that caught your attention, I'll link it in the description down below. It covers the structure, the math, the due diligence process in detail. Now let's talk private equity. Private equity means buying ownership in companies that aren't on the stock market. A PE fund might buy a chain of dental offices, say, for $10 million, improve operations, grow from 5 locations to maybe 15, and then sell 5 years later for $30 million. Your money is typically locked up for 7 to 10 years, and the minimums are usually $1 million or more. I don't currently invest in private equity funds, but the category is important to understand because it's the single largest allocation for both Yale and for Harvard, and it's where a significant portion of the real economic growth in this country is happening. Remember, 87% of major US companies are still private. So now the rest of the map. 4 more categories, and I want to be honest about where I stand in each one. Hedge funds use strategies like betting stocks go up, betting stocks go down, or maybe both at the same time. Some made money in 2022 when the broader market dropped 20%. They typically charge 2% of assets per year plus 20% of profits. Those fees are steep, and I don't currently invest in hedge funds. Real assets means real physical things. So farmland, timber, infrastructure, commodities. U.S. farmland has averaged about 10% per year since 1982, with significantly less volatility than stocks. Infrastructure, well, obviously, that's a huge and growing category. Roads, bridges, data centers, all requiring massive amounts of private capital. I find this category interesting, but I'm not personally invested in it. Digital assets, crypto, basically, now officially categorized as an alternative asset. Extremely volatile, highest risk category on the list. I used to invest here, but I no longer do, and I'm not going to pretend I have any edge at evaluating crypto versus all of the other talking heads that are in the world. And finally, we have collectibles, art, wine, watches, vintage cars, etc. More of a hobby than a really legit investment strategy. So that's the full map, and the thread connecting it all is simple. The biggest investors in the world use these categories extensively. Most of the rest of us have had almost zero exposure. If I'm going to tell you about the upside, I should probably tell you about the downside as well. And I'm going to start with my own. My wife and I lost money on a multifamily equity deal. The operator underperformed, the market didn't cooperate, and we took a hit. So the building was purchased in late 21 or early 22. It was purchased with a variable rate on the mortgage. And then, of course, you know what happened with interest rates. They went through the roof. So no cash flow has ever been paid to us in the form of distributions, and the building is worth less than what it was. So as an equity investor, we are probably completely wiped out, but I'll have to wait until the deal goes full length to see how it turns out. As you might imagine, that experience is a big part of why I've shifted most of our capital to the debt fund side, where we're the lender and not the owner. And we're first in line to get paid, which, as you might imagine, I quite like. But I want you to hear it clearly. Alternatives, they're not all upside. If someone tells you otherwise, well, then they're probably trying to sell you something and you might want to grab your money and run in the other direction. 4 specific risks you need to understand. The first one is liquidity. Your money is going to be locked up. Depending upon the investment, that could be anywhere from 90 days to 10 years. So there's no app where you're going to be able to hit a button and sell. Yale itself had to put up $2.5 billion of private equity up for sale because distributions weren't keeping up with the capital calls. So if Yale can get caught by illiquidity, well, then so can you. Never put money into alternatives that you're going to need in the short term. Risk number 2 is valuation opacity. So stocks have a price every second of the trading day. Pick up your phone, look at it, you know what the price is. Alternatives, on the other hand, get valued quarterly, usually by the fund manager or maybe a third-party appraiser. Part of the low volatility, quote unquote, you see reported in alternatives return is real, but part of it is just because of the less frequent measurement. You can't compare a private fund's reported return to the S&P 500 like they're measuring the same thing. And then we have risk. The next risk is higher fees, way higher than an index fund. PE and private credit typically charge 1 to 2% management fees plus 15 to 20% of the profits. Hedge funds charge 2% plus 20% of the profits. Those fees eat into your net returns, and you need to factor them in when you're comparing to public market alternatives. And then we have manager risk. So this is the big one. With an index fund, you get the market return regardless of who's running it. With alternatives, the gap between the best and the worst managers, well, it's a pretty enormous gap. A great operator with a solid structure will produce consistent returns. A bad manager with the exact same structure will probably lose you money. Due diligence on the person or the team managing your capital is the single most important step in this entire process. So if you already own a REIT fund or a gold ETF in your brokerage account, you technically have some alternative exposure already. That's the most accessible entry point. No accreditation, no minimums, and no lockups. One step up from there are crowdfunding platforms. Some let you invest in private real estate for as little as 10 grand. This gives you exposure to the asset class without needing the accreditation. Then you've got private syndications, investing as a limited partner in a very specific deal. And this, as I mentioned earlier, is how Liz and I I got started with that mobile home park. Minimums can be anywhere from $25,000 to $100,000, and most require you to be an accredited investor. And then private credit and debt funds, typically $100,000 to $1 million minimums, almost always requiring accreditation, and this is where Liz and I are focused now. So the barrier to entry has dropped a lot on this stuff over the past decade. You don't need to be a billionaire, but I'll be straight with you. The strongest operators with the best deal terms and the most consistent track records still tend to show up at the higher minimums with accreditation requirements. That's just the reality of this space. One note on taxes, because it matters. Income from debt funds is usually taxed as ordinary income, though some funds are structured so that distributions get treated as qualified dividends, which is a better deal from a tax perspective. Equity deals may qualify for capital gains treatment. Partnerships send K-1 forms, which add complexity to your tax return, so you need to talk to your CPA before you commit to anything, because that's what I always do, and I recommend that you do the same. Alternative assets make sense if you've got capital that's earning mediocre returns and you want something better. If you want real diversification beyond stocks and rental properties, and/or if you're willing to let your money be locked up for a period of time because you think the returns justify it. And if you're willing to do the homework on the people managing your capital. All of this stuff is important. You need to think twice if you need your money available quicker. You need to think twice if complex fund structures make you uncomfortable, or if you're not willing to spend the time needed on due diligence. So here's what I would encourage you do this week. Go look up the Yale Endowments target allocation. When you see 2% domestic stocks and 65% alternatives, it hits a lot different once you actually understand what those categories are and how they work. It definitely changed my perspective, and I think it might change yours. So if this video opened up a new way of thinking about your portfolio, I would like to invite you to visit my website, investwithtrent.com, where you can join my newsletter for accredited investors, where you'll learn more about how you can invest in the same assets that I'm investing in. My name is Trent. Thanks for watching.